We all need to make smart decisions with our money. The Long-Term Investor podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at PlanCorp and the author of Making Money Simple, Peter Lazaroff.
My first distinct memory of money was during a night out with my family at a local pizza shop. And I don't really remember how old I was, but I'd guess no older than 6 or 7. We used to play this game at the table while we were waiting for our food where you'd drop 3 coins onto the table and you'd have to flick the center coin through the outside coins while someone put up a little goal with their fingers. We called it hockey. And anyways, we used to always play this game, and it's a relatively small restaurant, had a jukebox on the side. And I remember one night looking at the jukebox and we're flicking these coins, and I asked my dad for some money to pick out a song. Now, instead of handing over some change, my dad asked me, "Is it worth your money?" Now, I told him no, and he quickly responded, "Then it's not worth mine." The next time we went to that restaurant, I found myself eyeing the jukebox again, and we're playing hockey with our coins. And again, I asked my dad for some money to pick out songs on the jukebox. My dad asked the same question. He asked, "Is it worth your money?" And this time, thinking I was clever, I said yes, to which my dad responded, "Great, then you can spend your own." I don't know why this sticks out, but this lesson in the value of money is one of my most vivid memories as a child. My parents, they generally did the right thing with money. They didn't spend more than they earned, and they were good savers, but they didn't really ever sit down and formally teach me about money. Money wasn't an off-limits topic, but it also really wasn't a focal point of our routine family dinners. And my perception is that this isn't all that uncommon among most families. So when do we get an opportunity to learn about money? We don't learn about money basics in elementary school. We rarely teach high school seniors how to budget or pay bills. And most college graduates don't take a course in personal finance or receive an unbiased education in the right way to invest money. And it's even more unlikely that anyone's going to take a deep dive in college into financial planning topics like how to plan for retirement or buy a home or save for a kid's education or really any other situations in life that require an understanding of how to manage money. In school, you're given a lesson, then a test. In life, you're given a test, and then you learn a lesson. And money lessons can be expensive. And since this podcast is all about helping you make good decisions with your money, I think that understanding how I manage my own money might provide some helpful context. And I actually wrote a blog post on peterlazaroff.com called How I Invest My Money that was inspired by a collection of essays that Josh Brown, Brian Portnoy had collected, and it was illustrated by Carl Richards. Really an all-star group of financial professionals had contributed to the book. They shared personal stories, and they gave little glimpses into how they personally manage their own assets. The book's relatively short read. Each chapter reflects a different perspective and approach to personal investment management. So it can be an interesting read, especially if you happen to follow any of the individuals who had contributed to this book. The various entries, they're not really actionable advice or really any novel investment insights, but I do think they kind of come together and create this overarching theme that shows that there's no one-size-fits-all solution to personal finances and investing. And I sort of felt like I wanted to do the same. Us advisors who are doling out advice, we are not robots. We're very human, and oftentimes our lives looks just as messy as everyone else. So while, like I said, I've shared a lot of stuff in my book, Making Money Simple, and on peterlazaroff.com, but prior to writing that blog post, I never really shared how I handled my own assets, liabilities, and spending habits. And so I felt like that was an excellent opportunity to do that, and I'm going to go ahead and do that here as well. So it's tempting to start with how I invest my portfolio, but to me, the portfolio is just one piece of a bigger puzzle, and therefore it's really not my go-to when I want to check to see how I'm doing financially. So I'm actually going to start with breaking down my assets, because if I ever want to know where I stand at a given point in time, I'll look at a net worth worksheet that I've maintained for over a decade at this point. And you can go get a copy of any of my worksheets always at wealthworksheets.com. And maybe I'll have a link in the longterminvestor.com where you can find podcast notes and such. But when I was a kid, I loved to see hard work translating into earned dollars that I could then use to add to my savings. And I worked all sorts of cash jobs throughout the school year and summer. I waited tables. I worked at car washes. Before I was of legal working age, so before age 16, I did basketball refereeing, babysitting, dog sitting, all sorts of different stuff. And while many kids, I imagine, are motivated to spend their summer job incomes or during school year incomes. I found myself watching my cash balance grow was way more satisfying. And so whenever I'd get paid, I'd go up to my room and I'd sit down on the floor and I'd pull the cash out of my top dresser drawer and start adding to it on the ground and count the entire amount. And seeing the cash add up felt like the best reward for my work. And maybe that's why I've consistently tracked my net worth in adulthood, because it allows me to see the cumulative results of my financial decisions. And updating my balance sheet every 6 months helps me stay motivated. It keeps me aware of the progress I'm making over time. And as I've grown older, I've found that there's been other benefits to maintaining an up-to-date balance sheet. In addition to just some of this sense of accomplishment, it helps me keep perspective because I can see the entire financial picture in one place. It also helps facilitate really productive financial conversations for my wife and I when we're sitting down looking at the numbers together. And that can be really helpful as we're planning for the future because it really reminds us to narrow our focus to what we can control. So I'm going to walk you through my balance sheet in detail first to help explain the full scope of my money allocation. So we'll start with the assets, we'll take a look at the liabilities, and then we'll end with spending because actually I think how you spend says far more about your values than how you invest. But let's start with my non-liquid assets. So the least liquid assets on my balance sheet are also my biggest. My ownership stake at PlanCorp is by far the largest asset on my balance sheet, and there's also a decent-sized liability tied to it via a business loan I took to purchase my stake in the company, but I'll get to that more in a later section when we're covering the liabilities. But when you look at my stake in PlanCorp plus my portfolio assets, it makes my balance sheet pretty closely tied to publicly traded markets. And I do think that this reflects where my comfort with market risk lies. Very comfortable with market risk. And as I get into the investment portfolio, I'll try to dive into that in more detail. But as we're going through these non-liquid assets, I look at that as non-liquid because I can't liquidate it any given day, quarter, or maybe even year. The next biggest asset on my balance sheet that's also fairly illiquid is my home. And I don't really think of my house as an asset, even though it's technically on my balance sheet. It's definitely not an investment either, but to me, a house is a form of consumption. It's a use asset. And I know that people can sometimes look at their house as an investment, but I really feel like it ought to be viewed as a place to live rather than an investment, unless you're a professional real estate investor. Because most of us are just going to own and live in a single home at a time, which means that most of our real estate success is going to boil down to good timing and luck. And unlike a traditional portfolio of stocks and bonds, a home is illiquid. It's indivisible, which means like you can't slice off a piece of your kitchen and sell it for cash. You have to sell. It's not divisible. It's a single asset. Again, very illiquid. And then it's also extremely undiversified. So it's a single bet on a single neighborhood in a single city, in a single region of the country. And so it's, these three things, the illiquidity, the indivisible asset nature of it, and the fact that it's undiversified. I mean, that's not a great investment if it's your only one. Again, professional real estate investor is a little different, but most of us are owning and living only in a single home. The other thing that most people don't realize is that homes offer very little long-term price appreciation if you adjust for inflation. So Nobel laureate Robert Shiller has some data that goes over 125 years that shows that after inflation, home prices, they've risen a little, but they're nearly flat, less than 1%. And so most people don't realize that the gains in housing prices mostly come from inflation. And when adjusting for inflation, a home actually depreciates in value over time, with the exception that you spend additional capital on maintenance and improvements. But look, that's not exactly something you want to see in what you're calling an investment. If you're a professional real estate investor, again, this is a very different conversation. But for those of us who live and own in a single house, if you didn't do any upkeep on your house, chances are, net of inflation, it is going to depreciate over time. Most of us do put money into our house in the form of maintenance and improvements. And so that's what helps it maintain its value after inflation, when you subtract out inflation. So you can see why I don't think of housing as an investment. And I led this off with saying, I don't even really see housing as an asset. Even though I include it on my balance sheet, it's more of a use asset. It's more of consumption. And I think a little bit of my indifference to thinking of my home as an asset is driven by the fact that my investment portfolio is going to surpass my home in size as a proportion of my balance sheet's assets. And the home will continue to shrink and be a smaller and smaller part of the overall balance sheet. So When I wrote the blog post on peterlazaroff.com, which is where I'm getting all the numbers from this episode, my house was representing 30% of my total assets. But I don't expect it to appreciate in value by more than the rate of inflation, if at all. Meanwhile, I expect my portfolio, which currently represents about 23% of my assets, to average a long-term return above inflation of somewhere between 6 and 7%, which is pretty much in line with what the historical real return on equities has been. I'm also regularly contributing to my investments, whereas I don't really know if I plan to regularly contribute money from my cash flow into my house in some kind of effort to make its value grow over time. Again, we are going to maintain, we're going to do projects that fit our lifestyle, shape it to our needs, but to me, that's purely consumption, not an investment. And I think a final thing to put on this housing conversation, and the reason I don't think of it as a long-term asset, is when I get to retirement, I don't have any plans of leveraging a reverse mortgage to slowly tap my home value in retirement in order to make ends meet. So essentially, this asset's something on my balance sheet that my kids will liquidate when me and my wife pass, or maybe we end up going to a different home because one of us can't get up to the master bedroom, go up the stairs anymore. But either way, whatever house we're living in, it's a place to live. And I'm mentally accounting for it as consumption rather than an asset or any sort of investment. That's really wrapping up the illiquid part of my assets. Now, my investment portfolio. And I feel like, there's a disclaimer at the beginning of every podcast episode, but I feel like I ought to say it's worth stating again that this is not investment advice. And even though I have that disclaimer at the beginning, maybe you skip through it. So I just want to say it again because I'm going to start naming specific securities here. So definitely not investment advice. I'm just trying to paint you a picture of how I invest my own portfolio. As Chief Investment Officer at PlanCorp, we oversee just under $6 billion in client assets as of this recording. And people are usually curious to know what it is that I do. And for me, I aim for simplicity. And many people are surprised to know that I own just a single mutual fund in my Roth and traditional IRAs, while my 401k just uses the most aggressive model that we offer. And roughly 70% of my family's overall portfolio is in different Roth IRA accounts. The bulk of those was funded when I rolled over my Roth 401k plan for my first employer. My wife also has made some contributions to Roth IRAs. But again, the bulk is coming from this big rollover. And when I was working at that company, I maxed out my retirement plan via payroll contributions, like hopefully many of you do. You make your contributions on the 15th and the 30th of every month. And I never really tweaked my asset allocation when I was at my first firm. I never timed my investments. Every 2 weeks, automatically invested into the firm's most aggressive model, which was 90% stocks and 10% bonds across a mix of index funds. The decision to invest my Roth 401k this way was relatively simple because the way my employer designed their plan, there was only index funds, and the models, they were created by our investment committee. So I made that decision right when I came out of college, and I didn't really have any reason to believe that I was smarter than the investment committee who created these models. So I set it that way and I left it alone. And boy, I am really glad I did, because while this highly diversified and low-cost index portfolio in my Roth 401k benefited from uninterrupted compounding during the early years of a massive bull market, I made all sorts of mistakes in my other investments that were in my taxable account and my Roth IRA. And I could do a super deep dive into all the investment mistakes I've made earlier in my career. And maybe that's a topic for another episode. But most of those mistakes can be summed up as me trying to outperform the market via security selection and market timing. And then I also learned how leveraged ETFs worked the hard way. But again, maybe a topic for another episode. I'm not entirely sure what my performance was relative to the market over that period, which unfortunately is a really painful truth that's basically true for all do-it-yourself investors. But fortunately, the automation and forced discipline of my Roth 401k meant I was overall in a good position when I joined PlanCorp in 2015. And at that time, I made the decision to roll all of my previous retirement plan assets into a Roth IRA and traditional IRA. And that's because the company, even though I was contributing to a Roth 401k, company matching contributions are required to go into a traditional 401k. So I rolled those into the traditional IRA and then my Roth 401k into the Roth IRA. And I had to make a choice. That's a big, big choice to make with a big pile of money. It's something I watch and coach clients through all the time is what do I do, whether it's a windfall or a change of jobs or an inheritance, some sort of all this money's in cash. I now need to decide where to put it. And for me, I felt the best way to protect myself from future errors and ensure that the largest account in my portfolio continued to thrive was to use a single fund and just set up automatic dividend reinvestment. Now, the fund I chose was DFA's Global Equity Portfolio, which invests in a global allocation of 100% stocks and utilizes the same systematic factor investing approach that we advise many of our clients who are seeking higher expected returns than what you would earn in an index fund. Just as a little context, we have 3 models that we offer to clients at PlanCorp. One is this factor model where you are trying to own the whole market, but overweighting towards factors or portfolio characteristics that have historically had higher returns, like cheap companies, small companies, highly profitable companies, or companies with positive momentum, just for example. And we also have index models where it's all index. You just track the benchmark each and every quarter, super low cost, super tax efficient, super simple. If you don't care about beating the market, or you really care about not losing to the market, an index portfolio can sometimes be the way to go. And then we also have ESG, which stands for environmental, social, and governance portfolios. And those portfolios, the risk and return characteristics are very similar to that of an index portfolio, but they overweight companies who do well on environmental, social, and governance issues, which is typically measured in something called like an ESG score. But just for context, I really feel like it's important for financial advisors to be eating their own cooking, meaning I should be investing the way that I recommend our clients to invest. And we have different options and different portfolios, but that definitely influenced my decision to use the same strategies we recommend for clients. And by going into a single fund that's globally diversified, 100% stocks, that's overweighted to some areas of the market that have a higher expected return, and it's not riskless, it's not guaranteed higher expected return, it's a higher expected return based on some quantitative strategies. But I felt like the worst case scenario over a multi-decade time horizon is I'd earn market-like returns. And it made it simple. I couldn't say I didn't like emerging markets, or I wanted more mid-cap, or I liked this and not that, or try to time it. If it's in one fund, it would do all the rebalancing for me, and I never have to think about it. Now, I don't currently own any taxable investments. I actually sold them all when I bought into PlanCorp, and I have since not had any taxable investments because I have some stuff that I'll get to in a little bit. But I plan to eventually purchase index funds in the taxable accounts, maybe a few years from now when my business loan that's tied to my stake in PlanCorp is paid down a little bit more. And so, I'm using this 100% stock fund as the primary driver of my investments. I think it's worth pointing out that I don't think I've ever recommended 100% stock allocation to anyone else, because I think the biggest mistake an advisor can make with an asset allocation recommendation is overestimating an investor's willingness to tolerate risk. And in my experience, this mistake typically is realized right in the middle of a market downturn. And so dialing back stock exposure once prices have already fallen sort of locks in what would have otherwise been temporary losses. So when I'm advising others, I find it's better to start a touch more conservative if there's any doubt at all about what the ideal asset allocation is. And you can always get more aggressive at a later date, ideally during a downturn, because it's much harder and way more painful to realize you need to be more conservative in the midst of a market downturn. So I don't know if there's anybody that I know well enough to say that they ought to be invested in 100% stocks, because in a downturn, there's not a whole lot you can do when you're in 100% stocks. It's very difficult to rebalance if you don't have bonds there. And seeing those big drawdowns can make you panic. And for me, having lived through a 60% drawdown during the Great Recession and not panicking, it made me realize I could handle the volatility of a 100% equity portfolio. Now, my wife, she has a 403B. It's globally invested across 100% stocks on 3 index funds. We have a health savings account, or HSA, which is, by the way, perhaps my favorite type of retirement account. And that's just invested in Vanguard Total World Stock Market Index. The HSA, I mentioned it's my favorite account. I won't go deep here, but the HSA, you get a tax deduction on the dollars that you contribute to it. And then if you invest those dollars, they grow tax-free. And then if you withdraw those dollars for healthcare related expenses, they come out tax-free. And we know that healthcare costs are only going up. And in retirement and older age, they're very high. So this to me is probably one of the best retirement saving accounts available to me. And so really, really excited every year when we get to make those contributions to that account. But I've been talking about being 100% stocks. I'm actually not truly 100% stocks because my 401k at PlanCorp is invested in 80% stock and 20% bond mix using the same funds that are recommended to PlanCorp clients that are taking a factor investing approach. And so just like with my previous employer, I make those payroll contributions every 2 weeks to the account and it gets maxed out over the course of the year. So what that means is my overall portfolio is slowly getting more conservative as my ongoing contributions to that account continue to grow through market growth. So I'm not really contributing anything to those Roth accounts that have all this single security in it, but I'm making these ongoing contributions to our firm's most aggressive model, which is 80% stocks, 20% bonds. So over time, I should become a little bit more conservative. And the decision I made when I chose a single fund for my personal accounts is that on my 50th birthday, I was going to convert my entire allocation to 70% stocks, 30% bonds on my 50th birthday. Now, if we're in the midst of a bear market, I'll wait until markets reach their previous high before adopting the more conservative allocation. But I just felt like it was the right thing. It's about the right age to dial back the risk a little bit. There wasn't a ton of science behind this decision, admittedly, but I'm going to stick to it. That's the plan that we have. And my wife and I, we feel like that's the right plan, and that's what we're going to keep doing. The only other investment accounts we have are our children's 529 plans. And between our two kids, we make monthly contributions up to the amount for which we'd receive a state tax deduction in Missouri. And our kids go to private school, so we're allowed to use $10,000 a year from those accounts to meet those K through 12 expenses. And so of what we contribute, $10,000 never even gets invested. It goes into a money market and it goes straight to the kids' school for tuition. We just take the tax deduction. But the remaining balance, it's invested in the most aggressive age-based model for both kids. Now, one final comment on all these investments is that I never look at them. I had to look at my investments last year in 2020 to write the article, How I Invest My Money, for peterlazaroff.com. And I'm actually using the percentages from that article to relay them to you here in this episode. But when I wrote the article in 2020, I was checking my portfolio for only the second time to write that article. And I'm recording this episode in June 2021, and I still haven't checked my portfolio this year. So the more often you look at your portfolio, the more likely you are to make unnecessary mistakes. And look, I do lots of due diligence in my role at PlanCorp that gives me a pretty good sense of what's going on in my portfolio, but I still don't need to look because it's multiple decades until I need the money. So why look? There's nothing I'm going to see there that ought to influence my decision that I put a lot of thought and time into. But if you're always looking at your portfolio, then you can have those seeds of doubt enter. And you make yourself susceptible to making an adjustment, maybe in response to trying to avoid loss. Well, whether that loss is relative or absolute, you keep checking your portfolio, you're more likely to see something that might make you change course. But I have a plan, I'm sticking to it. And honestly, that's probably going to be the defining factor in my portfolio's long-term success. Now, keeping down the balance sheet as I look at my cash, having an emergency fund, hugely important. In my opinion, people should have 3 to 12 months worth of living expenses set aside. And within that range, the specific size of your emergency fund should really correspond with your level of job security and the potential volatility of your income. Now, I've always targeted keeping 12 months expenses in cash reserves, but that's not so much because I feel like I need it for job security. The real reason I do it is just for flexibility. Flexibility to take career risk, flexibility to be opportunistic. I've probably emptied my emergency fund 3 times now in my career. The first time, 2 times were to invest in my business. And the third and most recent time was to buy during the market sell-off in 2020, invest at cheaper prices. Admittedly, I didn't really have much an emergency fund in 2007 and 2008 because I was just coming out of college. And so this last recession was really the first time I felt like I was able to invest in a recession in a meaningful fashion. So this emergency fund, I'll admit I use it a little bit opportunistically, but beyond the emergency fund, I try not to keep a ton of cash on hand. The only extra cash that sits around is a cash buffer in my checking account of maybe like 1 to 2 months expenses, just to cover the reimbursable work expenses and really to protect against any cash flow mismatches I have in my automated saving systems. So that's really the cash is really rounding out the asset side. The liabilities. And jumping to the liabilities, my mortgage is my biggest liability on my balance sheet. There's a point earlier in my career where I was hellbent on paying off my mortgage as quickly as possible. But that changed once I took out a loan to purchase my stake in Plan Corp. And that business loan, it's the second biggest liability on my balance sheet. Comes with the interest rate that's currently 3.5%, but can rise as high as 5.5%. And generally speaking, I'm aggressively paying down this loan with any extra income I get. So, aside from the maxing out of retirement accounts and contributing to 529s and making contributions to build up my emergency fund, pretty much all of my excess cash flow beyond those things goes to paying down the business loan. And once it's done, I'll assess how to use that freed up cash flow. I know I want some of it invested in a taxable account, but beyond that, there aren't any real solid plans for the use of that money that my wife and I have made at this point. But what I do know is that I don't think I'm going to be paying down my mortgage in advance unless I have some significant windfall or liquidity event. So an example would be, a corporate action that I have maybe stock options in, or receiving an inheritance, or winning the lottery, although we don't buy lottery tickets, so that's probably not a reasonable expectation. But I feel like I would need some sort of big windfall to mentally make myself okay with paying down a mortgage early. I have no doubt it would feel amazing to have no mortgage payment in my 30s and 40s, but I've been making mortgage payments since 2010, and in some way, it's almost like money I've never really had, and so I don't really miss it. And I think that the bigger driver behind my decision to not prepay my mortgage is that I really can't handle the math differential in return I could earn in the market. So if I were going to take excess cash flow to pay off any loan, it would probably be my business loan, even though the interest rate at 3.5 is not that bad. When it gets to 5.5, I'm a little bit more motivated. But if I were to take excess cash flow and put it into the market, the expected returns are much higher. And just seeing the differential and how that would change my wealth, it makes it hard to picture prepaying my mortgage ever. Auto loans, though, I'm pretty sure I'm allergic to auto loans. I've historically saved up for car purchases and just paid in cash. But the first time I did break down and take out a car loan was in 2017. I bought a car the day after our second child was born. We basically realized we couldn't fit 2 car seats into my existing car. And my existing car was 10 years old, so I didn't feel that bad about it. And I kind of knew that day was coming. And there was enough cash in our emergency fund to avoid taking the auto loan. But I felt like, gosh, the interest rate was so much lower than my business loan that I couldn't stomach using the cash on an auto loan and, just to avoid the cheaper debt. And so, I ultimately figured it'd be better to aggressively pay down that business loan and, like my mortgage, maintain a normal repayment schedule on the auto loan. But after a few months of making the car payments, I just couldn't handle it. And I paid off the loan in full. And look, I always go back to, I don't live life in a spreadsheet. You don't live life in a spreadsheet. And this is a really great example of what I mean. My wife, since writing this blog post, so this is kind of a new addition here for the podcast, she recently purchased a new car. And we tapped our emergency fund to avoid an auto loan then, which means that we're now making these auto loan-like payments to our emergency fund to restock it. But ultimately, I was really close for us to take out an auto loan again. And within the last hour of making the decision, I decided not to. It's just personal choice. I really dislike auto loans in general. I realize for some people that means you have to sit on cash that doesn't earn that much. But for us, it just works better. The final thing I want to get into is breaking down my spending. And we talk about how to save, how to invest so much, but I don't think that we being the financial profession, spends enough time talking about getting the most out of your spending. And I read a book a long time ago that remains my favorite resource on this topic. It's called Happy Money, The Science of Happier Spending. I cannot recommend it highly enough. I don't think a ton about my day-to-day spending because I follow a reverse budget. And I keep finding myself saying, oh, we'll have to tackle that in a future episode. And a reverse budget, look, we'll have to tackle that in a future episode. It's basically just a system that requires that I define how much I need to save to meet my goals, automates those savings, and then just allows me to spend whatever I want as I please. And we use a few credit cards that earn rewards for all the possible expenditures. And as long as there isn't a service fee, for example, we can pay our daycare bill using a credit card, but they charge 2%. So we don't do that. We end up just paying in cash automatically. But with those credit cards that are earning rewards, we automatically pay off the full balances each month. And we put all of our recurring expenses on automatic bill pay that can't be used by credit card. So I don't think day to day that much about my spending. And I'm not super into stuff, but I definitely do buy high quality items when I need something. So I feel like I drive a relatively nice car, but I drove my last one for 10 years and I intend to do the same with this one. I also feel like I live in a relatively nice house, which, as you heard earlier, I view as consumption. But again, I see it as a long-term purchase. I intend to live there until I can't physically walk up the stairs to the master bedroom. And I think really, though, the best spending habit of mine, and this is not for my whole family, I'm really specifically talking about myself, is that I never buy something on impulse. Even when I go to buy like a work shirt, I'll go to the mall, go to the store to buy a shirt, and I'll probably go there once. I'll come home with nothing, and then I'll go there a second time and come home with like 8 shirts, and then I'll return 6 of them. I have a hard time making a choice in spending. And when I'm at the checkout register, I was at Best Buy's getting a Father's Day gift, and there's a lot of cool stuff there. And I could see how if you had unlimited money, how it'd be fun to just impulse buy stuff, but it just never even crosses my mind that that's an option. So I think a really good habit for me personally is never buy something on impulse. But I do think the places I do like spending on quality when it's something I'm going to use for a long time. The other place I spend most on is probably experiences, whether that's vacations or playoff baseball or tickets to live performances or special occasion dinners. Experiences become part of our identity. And unlike most of the material purchases, the memories from these experiences, they make us feel more connected to our friends and family and the people that we're doing these with. So our family, we tend to prioritize experiential purchases. We also prioritize giving back because we find that we are fortunate in so many ways, and we feel it's important to help others. If you read that book, Happy Money, you'll see this is also one of the things that there's a really tight relationship between the way you spend and how much happiness you get out of it. But for whatever reason, we've typically given about 2% of our income to charity. And I have no idea if this is a reasonable amount or not, but it feels right to us. And we've also made giving part of our oldest son's allowance. We have a younger son who's probably going to get allowance for the first time, so going to have to train that giving concept into him. But with that spending, there you have it. That's how I invest and how I save and how I manage and how I spend my money. I wish I had done something like this for the conclusion of my book, which I still think remains the best resource if you want to understand the money management systems that I believe are best to implement if you want to save well, spend wisely, and invest for long-term growth. And if you read the book, you'll notice that I follow my own advice pretty closely, but I'm not a robot. I occasionally deviate from what I would be comfortable recommending to others, like the 100% stock allocation or the fact that I am unwilling to pay down certain debts in others. There's a mathematically correct answer to the choice sometimes of investing, saving for certain goals, or paying down debts. And that's one of those things where I just don't think that you can live in the spreadsheet. You have to do what's best for you. If you enjoyed this episode and you'd like some additional resources for learning about money, visit thelongterminvestor.com. You can easily access my favorite books, blog posts, and resources that'll help you make smart choices with your money. You can also, there's a place there to submit a question. So in a few episodes, we're going to start taking listener questions as well as reader questions that come in through my email. All these things you can find at The Long-Term Investor. Until next time, thanks for listening.
Thanks for listening to the Long-Term Investor podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of PlanCorp and BrightPlan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of PlanCorp or BrightPlan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of PlanCorp and BrightPlan may maintain positions in the securities discussed in this podcast.